and we're going to have a debate because Jenny just sold 3M, which, as you know, has just crushed it lately. Josh owns it, is not selling. Jenny, why'd you sell 3M?
So it has to do with when we owned it, why we owned it, and what its point in the portfolio was. Now remember, our equity income strategy, which is what this is in, has a 5% or better dividend yield for the whole portfolio. When we bought 3M, the yield was about 5%. That was 2 years ago. And we bought it thinking that enough of the PFAS and earplug litigation liabilities were already priced into the stock. We thought it was cheap enough. We thought the margin of safety was deep enough. So then we sat there for 2 years, and the stock was down, was sideways, essentially did nothing. But in the end, they cleared that up. They defined what the liabilities were. They spun off Solventum. They brought in a new CEO. Like, they really got things going well. And nobody appreciated that. Even last Thursday, nobody appreciated that. And so this whole time over these 2 years, as we're flat or down, we're reevaluating, why do we still own this? And we're thinking because it's worth a lot more. In fact, we thought it was worth at least $110 a share. And this goes back a month and a half around the Solventum spin. Our work said it's worth at least $110 a share. So we thought if we see it there, we're happy to get out. It just depends on how it gets there. So they blow out the earnings. Everyone gets on the bandwagon. Oh, this is great. The stock goes up 22% last Friday. It's way above our price target. And we kind of sat back on Friday, didn't react then, reevaluated on Monday, revisited the valuation work, and said, okay, here's where we stand. Now they're going to earn about $8 a share. That makes it a 16 times multiple. Given what this stock has done, given what the earnings growth is, which is good, a 16 times multiple is fair. I don't think it needs to be 21 times. So we exited the stock, we locked a nice little almost 15% gain in, held our dividends, punted the stock, and moved on.
Okay. Josh, you own it, as I said in this tease, that you're not selling. You want to, I guess, take the other side. I mean, look, it's hard to hate on a 15% profit, but what's your view?
Jenny, if you leave me now, you'll take away the biggest part of me. I'm not ready to have you out of this stock. I think Stephanie still owns it, so I'll be a little bit okay. But I want you back, and here's why. Here's why. This company is in a complete reset for the first time in decades, and it's exciting. This is a Dow component. It's the second smallest Dow component by market cap. In fact, it's the fourth longest tenured Dow component of all of the Dow 30. It's been in the index since 1976. That's before I was born. And one of the things that I like to do in situations like this, and I'm doing the same with Pfizer, by the way, which we'll talk about later, when a company is going through a complete and total reset, I like to give it enough time to fully capture the opportunity. And I completely understand Jenny's reason behind selling. It's a nice big gain. The dividend maybe is not as high percentage-wise as what it was now that the stock price has moved up. But anytime you see a company like this smash expectations, have an incredible reset by a brand new dynamic CEO, the stock had its best one-day rally since the year 1980 last week. I feel like that's a buying opportunity more than it's a selling opportunity because the market is screaming that things are going to change here and we're going to be back to earnings growth and put the days of paying off fines and settlements in the past. So I applaud Jenny for having been long the stock. I just think she's leaving in like the second inning. And I try not to do that with blue chip turnaround stories like this.
But here's the thing. When you manage a portfolio like mine that has very strong disciplines on both where you can buy and where you can sell, I can't keep holding this. It doesn't make sense for this strategy. If you look at the price target changes, right, everyone increased their price target. No. I never break the rules, and you know that. But if you look at the price target changes, they're between about 135 and 150. Let's call it 140. My worst case, if all of those super exuberant, rah, everything's new, bright, and shiny price targets are on point, I'm leaving like 8 to 12% on the table. I can easily reinvest the proceeds from my 3M in another stock that I think has at least 8 to 10% upside and probably has a 3.5 to 5% dividend yield, which makes sense for my strategy. So the discipline of the strategy cuts both ways. Sometimes it kicks me out earlier. A lot of times that happens. But it also really keeps the strategy like doing what it's intended to do. So yeah, like a growth strategy, I could let it run. I don't manage a growth strategy. I manage a dividend income strategy for this one.
Josh, last word.
I don't disagree with anything she said. The strategy should dictate how you behave and not vice versa. You should not decide you want to do something emotionally or because you have a hunch and then try to make it fit into the rules of what you're doing. So I applaud her discipline. I still think she's leaving a lot more money on the table than 12%, but I guess that'll be someone else. You know, whoever bought the shares she sold will be in line for that opportunity, and that's what makes the market.
We'll revisit it too.